When you look at the state of financing, the availability of financing here, how sound is it right now? How available is it?
Well, I actually think the system is sound. We haven't had a systemic issue at this point. If you step back from this recent, what maybe we'll call a rolling crisis, it really stems from what happened in the yield curve inverting at Silicon Valley Bank, where they were long 10-year treasuries, and in the arcane accounting, when you hold those to maturity, you don't have to write them off. But when people realized there'd be big write-offs, there was panic created, and people started pulling money out. And when you step back and think about the regulations, the regulators regulated banks in general were focused on the very large banks. The smaller banks and ones that grew up like Silicon Valley is a specialist bank, and I don't think people thought through the impact of a bank that is serving one customer, one broad group of customers, which is the tech industry. And if you had a tech industry crash, you'd be vulnerable. And so I think those two fears came to fore, and you got a classic bank run. And I think now that they have done the right thing and stepped in and fixed that.
Yeah.
First Republic has some similarity in that it is kind of a bank that's specialized in high net worth individuals, and as opposed to Bank of America or J.P. Morgan, a lot of deposits in First Republic are not insured because they're very large amounts by higher net worth individuals. So I think the regulators didn't think that through either, because if you have a lot of uninsured deposits and there is any wobbling, those are going to go out of there very quickly and cause a different kind of run. And then Credit Suisse is a larger, more diversified bank, but they have their own specific set of issues, and the government stepped in to stop that as well.
Well, that's what I'm curious about too here, because we talk about at least the three failures here in the U.S. and of course some of the other ones that are teetering, like First Republic, and what's going on with Credit Suisse. While there are certainly, I guess, some ties that binds us all together, they all seem to be very distinct stories in a way. And I'm curious as to how you get to Contagion, if at all, if what's driving the issues for each individual bank is separate from the other bank.
Well, Contagion is just fear, and when there's fear in the marketplace, you have problems, and so you need to set up systems to deal with that fear. And I think the regulators are jumping in to cap that off. I know that J.P. Morgan, Bank of America are very strong banks, and they've been very disciplined. You're looking at kind of a situation where a niche bank like SVB kicked off the fear, and then that ratcheted over to First Republic. And again, those are specific instances, and Credit Suisse is again its own case. So I'm hoping that this kind of fear doesn't kick off a major contagion. The contagion would have to be backed by some facts. There have to be very bad loans out there by some of the big banks, and we haven't seen that. We just have not seen that in this cycle. They've been highly regulated, they've been highly well capitalized, and they've been very well run.
Well, Steve, you brought up SVB, and I want to focus particularly on SVB and those ripple effects, because we know that a lot of startups, for example, received loans through SVB. And with SVB obviously out of the market, what does that mean for access to debt for some of those startup companies, those younger companies that need capital?
Well, it'll definitely hurt that market for startup debt. Now, I think private credit, which is growing very rapidly, will come in to fill that void at some point. But market uncertainty always hurts financing and deal making. So you're going to see a bit of a slowdown until things are calmer, the system calms down, and people come back into the market. But I suspect that private credit will fill in a lot of those holes, because normally good companies can get financing. And so in a normal market, they will get the financing. You're going to see a pullback right now, and that's certainly going to probably hurt the tech sector for a little bit.
Those private credit lenders who could step in to fill that void, do you think that there's going to be sort of more due diligence, more skepticism on some of the companies receiving those funds?
Yes, there's definitely be more discipline. If you step back, how did we get into this overall problem in the first place? We've had a 10-year run of maybe over-exuberance, very strong increase in the money supply, lowest interest rates ever. For the previous 40 years, T-bills were at 4.5% and 5%. That was the normal. They went down to below 1%. That was very cheap money, and people can speculate when you have cheap money, and you can take all the loans that you want. So now we've seen this correction in the marketplace, and I think it was inevitable because you cannot have rates that low and have that much money supply expansion without getting inflation, and so now we're seeing the effects of that.
We're in conversation right now with Steve Pagliuca over at Bain Capital. There are some headlines crossing the wire. A joint statement now being released by the Department of Treasury, the Federal Reserve, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency. It is short. It is brief. Just about 60 words, basically making it clear that today, 11 banks announced $30 billion in deposits for First Republic. This show of support by a group of large banks is most welcome and demonstrates the resiliency of the banking system, period. That is your statement here, short and sweet. Of course, this saga is not over, Steve, and I do wonder here about regulation going forward. There is concern here that even if we avert this crisis of additional bank failures, bigger bank failures, that there will be some additional regulation coming down the line that could maybe hamstring the ability of these banks, whether big or large, to, I guess, operate and lend in the way that I think the market wants them to.
It's a balancing act, Romaine, and we've seen cycles, repeated cycles since the 20s of overexuberance and then a pullback and banking issues. So people get carried away. What really has to happen is there has to be very clear regulation, very efficient regulation, where the banks cannot put themselves in a situation where they have way too many debts or taking too much risks. So I think you can bridge that gap and you can put in effective regulation. And at every crisis, we learn something different. We learned about derivatives and swaps, how they brought the market down in 2008. That's been limited. And now we've learned that you have to have different rules for niche banking that relies on one sector or one kind of customer because there's not enough diversification. So those are the kind of rules that will have to come in, and they should be pragmatic. They should be easy to follow and make common sense.
And Steve, you caught up with Bloomberg Television back in January, and it feels like a long time since January. And your comments at the time were that when you look at private equity returns, obviously they've been booming, had a really good run. You said that that industry is still in its early innings, that we can expect those types of returns for decades to come. What you've seen over the past few weeks, what we've seen with the collapse of 3 U.S. lenders, does that change your forecast at all when it comes to private equity?
It does not change my forecast because private equity is a fundamentally sound model. And in fact, if you look at returns after the biggest crisis we've lived through, we've been through the crisis in '99, the 2008 crash, private equity has performed very well. And again, it's all about discipline, and it's about identifying companies that can grow and finding the right price and right leverage level for those companies. So the very good private equity firms have done well in those environments as well as exuberant environments. And you've got to pull back in exuberant environments, and then you can invest in environments where the pricing actually gets you to a place where you can make good returns. So I don't change that at all. I think it's a really good model. And in fact, it's very well needed. These companies are going to need capital, and they're going to turn to private credit and private equity to get that capital through this what's going to be a liquidity squeeze caused by these failures.